Good afternoon and welcome to Chicago, Future of Finance. I'm Oliver Renick. We've got a pretty busy session here. It's a bloodbath in crypto. It's a little bit of a stress test in stocks, and the metals are also getting hit. It's definitely an unwind day. There are some elements of rotation still in the market that we talked about from the last few sessions, but overall, this is pretty ugly. Today, the only thing you got really working is staples and utilities, so that's a pretty clear sign of risk off when that's your only sector of the market holding in for the ride. And looking at the toss right now, some of the groups that are under some extreme pressure are some of the usual suspects as of late, discretionary down, but the unwind in materials after looking pretty good the other day, and banks as well, shows that there is some risk coming off fairly substantially in the market. Some of the stuff that has been holding in has indeed gotten dragged now. But there are a few things that are up. You got some healthcare stocks that are up. Yeah, got a few tech names in there like Skyworks that is actually okay today. But generally, this is obviously a pretty painful session. But look at VIX. It's largely just continuing the trend that we've seen here over the last couple months, which has been higher highs and higher lows in VIX. Pretty amazing technical work on the chart for volatility. As many say, you're not supposed to draw lines on the VIX chart. Well, this line is working pretty well. As we've generally talked about, it seems mostly like the index volatility is now getting in line with some of the single stock volatility that we've had. As you look at the correlations popping, here's that chart of Core 1M we've been tracking. Below 8 looked like a little bit too complacent, a little low. And so now we see correlations rising. That's the main story here today in terms of the broad market. But of course, the most interesting story is Mutiny on the strategy. Michael Saylor's Bitcoin experiment is trading below $110 now. And of course, Bitcoin is below his break even as we approach 60K, which was the line that I had on the chart when I pointed out over the past week that if this thing cracked 80, it was likely to get down to 60 in a hurry. This is what's so great about Bitcoin is you can have strong underlying core principle beliefs like I do that generally it's not a very useful asset whatsoever, but you can also just follow the technicals. Seeing when this pure risk asset breaks out or breaks down offers a very good educational course basically in how to think about charts. So you had pretty clear support at 85,000 first, the range that we had been trading in, that broke, and then 80,000 was kind of that line in the sand that we had tested and held back in the spring. So that falls through, and now suddenly you have this real kind of cycle of pain because the break-even for strategy was at the mid-70s. Michael Saylor is asking people to hodl. Now, he had a very different tone. I saw him in Vegas for the Bitcoin conference about a year ago, almost, about, 9 months ago, when I asked him about my short master long stocks or long Bitcoin trade. He said, you'll probably get your face ripped off. And, well, here we are. Definitely some face ripping going on, but it's not mine. It's in the crypto world, and this could get pretty ugly. The big point that I've talked about with strategy is that it assumed the risk properties of Bitcoin, which made it appealing to many. The volatility and the risk was the appeal of Bitcoin. But when you take the asset, wrap it in debt and leverage and package that into a different instrument. Now that's something that's even more risky because that's a thing that can go to zero. Companies, of course, can go bankrupt and can go to zero. So there's no telling really how bloody it could get. The other thing that I've talked about is the bearish divergence that's been in Bitcoin for a very long time. No other asset in history has a bearish divergence across its entire existence, but Bitcoin's became very obvious looking at this chart here over the past year. As it was making higher highs, it was making lower highs in momentum in RSI. So right now you're oversold in Bitcoin. You're down here at a 28 RSI. So maybe you find some support at that 60K. That's pretty much the thought that I have on Bitcoin for now, is that 60K was the target from about 10 days ago, and we're almost there. So let's get some other thoughts. We got a great show coming up, by the way. We've got a whole host of fantastic folks joining us. Streible joins me from Blue Line Futures right off the top. Then we've got Mr. JJ Kinahan, Chicago icon, and the man who brought me to this wonderful city about 8.5 years ago now at Cboe, joining us to talk about retail expansion and innovation efforts. Implodes. And our sponsor for this show, Innovator ETFs, Tim Urbanowicz, is going to join us to talk about the craze in buffer funds and what they've got in store. Then Charlie Moon of Prosper Trading Academy will be here to cap it off with us into the bell. Right now, I've got Mr. Phil Streible joining me from the great state of Florida. Phil, I worry about Miami right now, the crypto capital of America. What's going on, man?
Wow, yeah, an incredible sell-off here, and it's a cascading effect on all these different asset classes, everything from the equities, the cryptos, the precious metals. No real safe haven out there. The one market that is interesting is that we saw 10-year treasury yields come off about 4.3%. They're sitting at about 4.22, and we're seeing a little bit of a bid here on 10
That's a good point. Finally, someone bought bonds, right? Because the last few days, market had no interest in bonds. I think that's good eyes and an underappreciated story today, Phil.
Yeah, I mean, a lot of these central banks have been protesting, or different governments have been protesting U.S. Treasuries and things like that. And perhaps you're seeing a larger liquidation where they're finally throwing in the towel and going back to their traditional asset classes. One thing to note on your chart on Bitcoin is I was looking at that peak that we saw right around that 125, 127, and you come down to this latest breakdown right here. If you go a measured move on it, it's about a $45,000 drop. So you take that from where we just broke that key level of support. It really takes Bitcoin down to 40,000. So I know you got your 60 as your first stop, but just like taking the red line, the blue line, whatever, you get both stops, all right, before you get your destination.
Okay, so take me through that again, how you calculate that distance, because I mean that's the great question here is, strategy. I mean, look, as long as this thing's trading under its break even, it is in serious trouble. But Bitcoin still is a separate asset that, obviously it's very linked to these things, but how do we kind of figure out where that price action might take us?
Go from that 127, wherever you got that top there, the very, very high of the chart, and drop it down to where your yellow line is, which is at 80
That's
grand.
80, yep. Okay, so about 45 or so, 47.50,
realistically, realistically, the neckline that I have drawn is where we broke it a couple days prior to that. So it's like 82, 84,000, somewhere up there where it broke. But if you take the distance from that head to that neckline, and then you draw that replication down, that's a measured move on the chart. And a lot of times that's how you see the process break out. So just basic technical analysis. And oftentimes keeping things really simple, I think is the best way to trade these markets, and just basic chart analysis, nothing too fancy.
Okay. So if 60 doesn't hold, then I mean, geez, who knows what's possible? But I would think, here's the thing: is there's other signs of appetite in this market. This SMH is up today. I mean, barely, but it's up. Nvidia was higher earlier. VIX at 20 is not screaming, disaster. We've had this steady climb in VIX now for the better part of the, a couple months in the whole year. But if any of that kind of risk appetite stabilizes, then I would think BTC might find some support somewhere around that 60K as it realizes some of these, expected moves.
One thing that I did see was that, and I'm gonna have to verify this story, but it was like that Trump media group or whatever who holds a lot of Bitcoin, whatever his crypto asset portfolio. It was saying that it offloaded like something like $5 million in I don't know what the amount was, but it was quite a bit of Bitcoin that it was unloading. And if you get these large institutions or people that are just private holders of it giving up on this asset class, there may be no bid on there. And that's what we saw today, was no real rally in that particular asset whatsoever.
So there's no appetite for it right now. What do you make of the gold move and the silver move? Because silver is also getting blasted again today. You and I talked quite a bit these last couple of weeks about silver kind of assuming some of those Bitcoin volatility properties. Not a great bedfellow right now to be trading similar to this asset, but at least silver is at a level it was at the beginning of the month, and this kind of range now that we're developing after the big crash last week.
Yeah, that 69 and a quarter is going to be your critical level of support. I think if it breaks there, it opens up a wider move into the, the low 50s or whatever, but you really don't want to see it take out those lows. And, realistically at 92, I think a lot of people were lucky to get some of their skin back. So they took some of the positions off there, and then it became this risk off cascading event across a lot of different markets here. And it's this breakdown that causes, these systematic meltdowns across these major asset classes. A lot of the momentum traders, and it's really been the momentum dying. You get shots across the bow with the NASDAQ here, with some of the cannibalism that's taken place with AI and CapEx spending between different companies. Feels like they're kind of attacking each other by trying to replace certain different things with AI. And then you get this breakdown in Bitcoin and then silver, and it's just the momentum trade is dying off right now.
Okay. When you look at the bond move, as you pointed out, catching a bit into bonds, dollar even as well. Obviously, the dollar bounce here is disrupting the commodity trade. You guys are kind of the experts in commodities. You guys know it as good as anybody I know from Blue Line. So is this dollar creating a problem? I do see on my chart potential resistance for the dollar right around here. So maybe that gives some hope for dip buying in gold, crude, silver, etc. Because even crude had a nice couple of weeks there.
Yeah, crude oil has been at a pretty decent level, holding that $60 to $65 range. Geopolitics is playing a role on that. We also seen some of the inventories. The latest EIA inventory data showed another drawdown. We're sitting below the 5-year average as far as how much crude oil that the U.S. has at the moment versus the 5-year. The dollar index is near a resistance point. I wouldn't be surprised to see it give up some of its gains here. Because of the fact that we're seeing just this risk off and we're seeing yields come down with it. So we'll want to keep an eye on that. There were 2 central bank decisions out. I didn't catch the details on the ECB or the Bank of England, but realistically, again, once this risk off comes into play, some of these markets kind of find their new ranges here, then you could come with a strategy. The volatility on a lot of different markets like silver and gold are still off the charts. And I got to tell these clients that it's like stepping outside your house just because it was sunny and warm and puppy dogs out there 2 days ago. There's an actual tornado outside. So you got to be prepared if you're going to trade some of these markets.
Okay. The preparation at this point, Phil, how does it incorporate the economic data in your mind? The ISM services was good. The ISM manufacturing was good. I do think that the jobless claims coming in a little bit above expectations is not a big deal. I think JOLTS too, given some of the government shutdown, it could be worse, these numbers. I don't really see the volatility in markets at this point being a referendum on the economy. What do you think?
110%. If you look at the economy on paper and you look at the global economy, I mean, it's doing great. Growth is accelerating. Companies are getting better. Yeah, there's some weakness in the labor market, and that's all going to shake itself out over time. You did have the lag on the data and everything from the government shutdown, but as far as economic growth is concerned in the economy, everything looks like it would paint a much different picture. Even earnings growth, with the bulk of the companies in the S&P exceeding analysts' expectations. Russell growth is off the charts right now. So from that aspect, things are fine. Perhaps some of these assets are just a little bit frothy. I think there is some real back and forth action, some blows being back and forth in the NASDAQ between different companies like ServiceNow and things like Anthropic and everything. But the metals complex, perhaps a little bit over speculated in, and you're seeing a lot of these different exchanges, not only in the US, but globally, are raising margin requirements. So they're trying to bring this back down from orbit. And then the Bitcoin trade, well, that's just a whole nother story of deleveraging taking place.
Is there a potential macro-driven, is there a feedback loop, do you think, Phil? Like when household ownership of equities is at the all-time high, there was a lot of retail participation in, some of the crypto markets. Does this stuff, if it gets ugly enough, start to go back the other way? Or do you think the bubbles that we're popping right now are they kind of cordoned off? You know, because I think to some extent the crypto world is like that. Like I was joking about Miami, but like, you know, there are very concentrated areas of these risks. I'm not sure if they expand out wider to the broader economy. And that's a view that I've kind of adapted over the years, because I think of, you know, several years ago it might have had a bigger impact, but not since AI. You got the whole stock market moving on AI stuff now, you know, maybe we just flip crypto off, you know, continue on our way.
Yeah, the problem is the widespread adoption. I mean, I had never used crypto to buy anything in my life. I've speculated at many different times, and that's been the issue. One time, back when you were on your previous network, I was saying that crypto was useless, and you were telling me that, you know, if somebody was having like if it was like a church group in another country that you needed to get them some funds, it was an easy way to do it. And that's
or an online poker ring.
Yeah. But you know, I think that it just can't get its act together on what it's actually used for, and that's the problem there. At least I could take a gold or silver bar and hit someone in the head, or throw somebody, or use it as a doorstop. I just can't do that. I can't do that with Bitcoin. So that's the big problem there. When you're talking about some of these markets selling off that have done so well and bubbles are popping, one of the problems is that some of the participants that were not involved with the bubble when it was inflating are now trying to catch the bubble and catch the knife when it's falling. And, you know, I've had a lot of people inquiring about XRP at like $1.18. Well, that thing is absolutely collapsed. It's down 23% today. It's down 35 cents. And if, you know, you're going to put all your money in that's not a wise decision either.
How aggressively do you think it's worth going after the metals trade at this point, Phil? I wonder, as you see some of the AI themes or the software themes, you know, the stuff that's been disrupted in the equity world that's been selling off really hard, I wonder which of these dips is more appealing. You know, like on the one hand, I look at the silver and the gold dip and I go, okay, that's been the momentum trade. I'm eager to scoop that up, but then I also wonder if that stuff, you know, that doesn't generate cash flow, that doesn't generate earnings, I wonder if our backdrop for the economy is okay. Maybe I am better off taking a shot at some of the beat up equity stuff out there.
Well, if you're going to take a shot, like in the metal space, I think you just stick to the gold market, and you stick to copper, because if we get a snapback here and data centers, AI, things like that, you're going to see copper is the one that everyone needs here. Copper production, multi-year deficit, that's a problem right there. You know, silver, once it gets too high, it does face a degree of substitution risk. At what point would solar panels just be not worth it, or companies would look to, you know, people aren't buying silverware because it costs too high, things like that. The gold market, at least gold is a tier one asset, so central banks can hold it, and it's good as cash. It's as good as bonds and things like that. So those are the two. The gold and the copper, I think, are the right ones. We'll see on the silver if some of the volatility comes out of it once the exchange launches the 100-ounce contract next week. But if I'm going to go and put my money in any of these indices, it's going to be the Russell 2000, because small caps aren't spending that CapEx spending. They're going to benefit if things sell off here, if yields come down. Small business optimism continues to grow. So I just think that, you know, that's the logical place to be. It's also the last index that's still bullish trend, in my opinion.
Look at the regional banks, by the way. Very solid chart still. Just cruising through this kind of chaos in the other asset classes very smoothly. And to your point, IWM as well, pulling back for about a week or so, but a pretty clear trend still of higher highs and higher lows, a solid looking chart. And I like the reminder that gold is a tier one asset, maybe just gives you an opportunity to kind of retool your portfolio here, get rid of some of the stuff that's on shaky ground, and maybe take something from the last couple of years of what you've learned on how these things diversify each other, which is that Bitcoin is like risk with downside attached, and gold is diversification with upside attached. And maybe if you want something more gambly in there, then you dabble in a silver, or you dabble in maybe a copper that might have some higher volatility, or even maybe the small cap. So I love the perspective. Phil, you the man. Thank you very much, sir.
Yeah, thank you.
Phil Streible, Chief Market Strategist of Blue Line Futures. Always a great look at the commodity space in particular. 2-minute Innovator buffer break. And then we're coming back with Tim Urbanowicz from the team for this week's Cboe Exchange Traded Profile. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Sure.
Welcome back to Chicago Future of Finance. I'm Oliver Renick. I'm here with a very special guest, the man who brought me to Chicago about 8.5 years ago, the one and only JJ Kinahan, now the Senior Vice President at Cboe, Head of Retail Expansion and Alternative Investment Products. But
It's a lot to say.
I still kind of call you boss man, JJ. Good to see you again.
Well, it's great to be with you, Oliver. Great to see all that you've done in your career.
Thank you, sir.
From a guy who 8.5 years ago, I would say, had a very limited knowledge base on options to somebody
Sure.
who knows them cold now. And
I appreciate that.
And certainly
I'll take
come
that.
a long way on fixed income, too. That kind of seemed to be a little bit of your sweet spot,
Yeah.
if you will, for many years.
I
So
appreciate that.
It's great to see you, man.
It's good to see you again. I thought it'd be kind of fun just to start, as we're now here under this roof, obviously
Yeah.
a place that's iconic. What do you think has been that main story over the last 8 years? And I'll kind of prime it by saying, this is Chicago Future of Finance. And I came up with that title, and I think from a very high integrity, honest position. I really do feel like that's kind of why we're here.
I agree 100%. You can see how, I think it's so exciting that we still have a trading floor here, as well as what goes on in terms of things online, so that those who want to trade smaller contracts can get filled really quickly. Those who want to get filled at much bigger contracts, some of the institutional firms of the world, can get one price. This is what they really, really want to do, and get it on a lot of contracts. So there really is a great dichotomy in what goes on here. We've seen the SPX become much more of a retail product. So to really answer your question in a direct way, what's changed the most? I've been on the retail side of the business for a long time after being a trader in the pit for many years. And retail's influence is really the number one thing. You help contribute to it with the education you still do, with all the education you do every single day, helping people understand the markets better. And I think one of the things that people don't really place a high enough value on what you do every day, Oliver, is you give people ideas. And when you're sitting at home, it really is difficult to say, what should I do now? What's interesting? They may not take your exact idea, but you're making them think. And so we'll just say you talked about Apple for some reason, and an Apple call out a couple of weeks or whatever. They may think about that and say, well, maybe I don't want to do Apple, but on Oliver's premise, maybe that also applies to Amazon. So
Sure.
maybe I want to go do something there. So I think it's really great what you're doing, because you got to continue to throw out the ideas and just make people think. I love that, retail is finally getting their just dues. I've spent so many years of my life saying people are smarter than you think they are.
Yes.
And what you're doing that's great is you're challenging people, and that's exactly what smart people want, is to be challenged.
I love that, and I think that also there is this first step of giving people that opportunity, which is understanding that they have the potential. And I think that's where you, Steve Quirk, now at Robinhood, and when we started our operation and from the media side, you have to give people that belief that they want to take control, they want to understand, they're willing to learn. There's a very much misplaced, I think, concept of what retail is and what they're capable of. And now, lo and behold, not only are they trading options, but they're understanding second-order derivatives. Yeah. They're trading options flows. They're trying to find opportunities for themselves to catch up to an extent. Now, obviously, you play by the sword. You got to be careful not to get cut as well. And we got a market right now that some of this stuff is cutting pretty hard. But stocks actually are holding in. You're getting some of this crypto stuff hit. You're getting some of the golds, the metals hit. What do you think this kind of year so far is shaped up for in terms of kind of understanding how these asset classes are playing against each other?
If I were to say the biggest surprise to me so far has been Microsoft, and how hard Microsoft has gotten hit. because that's a stock that if I look back over the last few years, we're buy the dip, and buy the dip mentality has really, really paid off for people. That's the stock that led from the retail point of view. It was the first one people bought, like, okay, I have confidence, they have this amazing cash flow, they continue to innovate. The fact that they just, that's a pretty ugly chart over the last few days.
Yeah, I think the worst MAGS chart probably right now.
And that, to me, has been the most surprising thing I've seen so far. The other crazy stories in the year so far to me has been what I'll call the meme of commodities, and that being silver. And all of a sudden, many of your really smart people watching this are trading it, hopefully trading it in a way that you're defining your risk, et cetera.
Right.
And all that we've talked about in the last few minutes, I think the biggest thing that we've always stressed, and you've stressed since you've been on the air, I've stressed, defining your risk. So yes, there are going to be times when you lose money. There's no question about that. That's unfortunately part of trading. But I think one of the really important things for people to realize is that if you define,
Bingo.
risk not thy whole
That's
lot.
the beauty of the options. That's what part of the reason why options became so
100%,
popular.
yeah.
Mathematically being able to see your risk, being able to price it out. That's where I think there still is a bit of a misconception sometimes where people think that this is the avenue of pure speculation. It's really not. It's about putting on high probability trades. And if you want to speculate, being able to define your own degree of speculation, which is, I think, key.
There's nothing wrong with speculation.
Yeah.
And I think for some reason, people are like, oh my God, it's terrible if you do that. There's nothing wrong with speculation. But again, when you speculate, one of the beautiful things about options is there's something called delta. What a delta is telling you is this is your probability right up front of even, so if you're going to buy that call that's pretty far out of the money, it may have a 15 delta. There's only a 15% probability it's going to finish worth a penny.
Yeah.
So if you're paying
maybe
50
that's
cents
the 15
for
cents
it,
you got.
Yeah. So again, understanding that I think is really important for people who are going to speculate.
Okay, now here's where we kind of get to the crux of what you're doing here at Cboe. Alternative investment products. I mean, we've kind of talked about some of that retail expansion outreach,
Sure.
which I think is an extension of kind of the things that you've built your career on and teaching people and educating people. But when I'm doing a show on future of finance, one thing that I got to have is I talk about event contracts. For the first time ever, me, I'm not like a big sports guy, but some of my guests like to think about it. So we dabble because the Bears did so good. But when I think about event contracts for me, what's exciting to me is that things that I used to not talk about on a trading and quantitative show, I now can. Because it's not a speculation or a guesswork or my own political opinion about an event. It's a market that's priced a certain event that's coming up, and now I can express that in a way that I couldn't do before. I can talk about these non-market events in a quantitative way. How does that fit into your understanding of alternative investment products and what you want to do?
Yeah, so it's funny you bring up sports. So the first thing I'll tell people is Oliver talked about the fact that he came here 8.5 years ago. The first thing I told Oliver to do is learn how to play golf. I said
and the last thing you told me to do too.
and
I made zero progress.
And I'm not that I'm a good golfer. It's just that it's a good place to get business done still in our business. Yeah. And he also became a White Sox fan because I took him to a Sox game.
That's true. I'm an underdog guy.
Yeah. So anyway, all that said. I think prediction markets are really important because what it allows you to do, and I'll keep it we'll keep it on the market side of things even, not even speculative outside, what color dress Taylor Swift is going to wear to something. We'll just keep it to CPI, PPI, this stuff you're talking about every day. Employment, you saw this morning this employment report came out. It had a big effect on what happened in the market. So when you want to talk about employment, et cetera, yes, you can invest in it through volatility or taking a position in, SPX back behind me, et cetera. But this is a way you can do it very directly in terms of what is going to happen there.
Yeah.
And so I think it's really important. It gives people a chance to really hedge something, not only to retail investor, but also firms, so that they can hedge some of their risk, et cetera. So I couldn't tell you how excited I am about that. The other thing that I'm doing as part of my role here is taking us to tokenization. Okay. I think tokenization becomes even more important on the clearing side of the business, which isn't a very exciting or sexy side of the business, doesn't necessarily face you, but can we make things so they settle faster, which you may care about, so that you can use your money again very, very quickly.
Okay.
As well as, should there be some products that we're going to tokenize also. Okay. So that's a big, big area right now. The biggest area that you have to do in tokenization is really sort of narrow it down and say, where are we going to focus, what are going to be our priorities, because otherwise it becomes too big. And as you and I have talked a million times, if you're going to focus on everything, you're going to get nothing done.
Sure, and I think what's important about that too is there's a separation kind of the price action for the speculative items, which is, hey, if you want to play in the crypto sandpit, go for it. But also the technology, that there's still something to be wrung out from that entire asset class that may not be related to speculation, that may not be related to price action.
And you know, the way I also look at it, also crypto is going to be under my domain of things to get done in a better way. We have some perpetual futures offerings right now, which we're really excited about, and I think we can expand a lot of what we're doing there.
Okay.
And the way I look at, you know, I love the fact of always learning new things and how the market's going differently. And so I really feel like crypto's in about the second or third inning. You know, if we look at prediction markets, they're probably in the 1.5. And if we look at tokenization, it's warming up in the bullpen.
Yeah.
You know,
okay.
It hasn't even really entered the game yet for most people. So it's exciting.
The event contracts, the last thing I'll say about that, because I kind of want your take on this, because there's a lot of people kind of chiming in from outside the investment world that are very much against this.
Sure.
But in my view, it's very simple, which is anything that allows us as people to make money on being right, supplying liquidity pools for being able to predict the future is like, how can that ever be a bad thing, basically?
Well,
that's kind of my extreme, you know, libertarian
yeah, I was
kind
going
of,
to say,
if you will,
the true
philosophy.
libertarian view, I agree that's it. I will say, you know, we're a regulated marketplace, so we'll go in there with a bit of a regulated view in terms of things that affect the market to start, and then we'll see what kind of regulations happen from there. But I think it's wrong to just say they're all bad, they're all wrong. That's a silly point of view when there are things that can help the investors to, you know, spread risk. And again, there's liquidity in all these products from a lot of regulated firms. I think one of the great things about exchanges, they're trusted places to go because there's something, you know, there's something behind them in terms of regulate. I mean, such a regulated business is crazy. And the people here, you know that the exchanges are standing behind the trades, guaranteeing the trades. That means a lot. We've seen some of the other places where people may go run into, did it happen? Did it actually not happen?
Yeah, put those guardrails on the highway, right?
Yeah.
I'll understand kind of where the meeting, the guardrails are. JJ, great to see you again.
Great to
be
be with you, Oliver.
Great circle of life here in Chicago.
Brings back a lot of memories.
Absolutely, future finance. JJ Kinahan, senior vice president at Cboe, head of alternative investment products and retail expansion. Good stuff, JJ. Fun convo.
Thanks,
we'll be
Oliver.
right back with the Cboe Exchange Traded Profile with the Innovator team in a moment.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. Joining me on the Zoom, Tim Urbanowicz, for today's This Week's Exchange Traded Profile, the sponsor himself and the Innovator team. Tim, great to have you on the show. How you doing?
Great to see you, Oliver. It's great to be with you.
Likewise. You guys have had a lot going on since we last talked. You got some new funds, obviously the monthly update. Folks who've been watching the show carefully will notice that our ticker changes on the banner per month for your guys' double buffer fund. Let's start there, because with a little chop in markets, I feel like you guys might be getting some fresh attention on that thing.
It is, Oliver, and we always have advisors that are looking to protect on the downside and keep exposure to the market. But right now, I think that's becoming more and more real with these markets selling off the way they are. So we've seen a tremendous amount of interest here recently in a couple different areas. The dual direction strategies in particular have been very popular here over the last week or so. With the volatility and really with those strategies like DDFF, if you look at that strategy, it's the February version, but you have a 15% inverse cap on the downside, meaning that if the market goes down 0 to minus 15%, you're going to be going up 0 to plus 15%. And then on the upside, if the market just goes up, you have an upside cap of right around 9%. So it's really good coverage. I think one of the things that we're showing our clients a lot of here is just looking at those guardrails in the context of what are the potential scenarios that could be playing out this year. If you look at the most bullish forecasts out there from companies on the street, whether it be an Oppenheimer, a Deutsche Bank, somebody like that, that 9%, that's covering you for 80, 85% of those high targets. And then on the downside, that 15% inverse cap allows you to make money in, more than 95% of the targets that we see out there. So it's really powerful guardrails, and I think a lot of investors are really starting to gravitate these strategies for that.
Obviously, when you guys talk about this thing, and the way a lot of people think about it is they think about protection. They think about making sure they don't lose their nest egg. They don't blow up. They want to have that downside buffer, where the name comes from. But the thing that I've always found kind of interesting about your guys' strategy is that if you are someone who's looking to short the market, this is actually a way from a retail side that you can express it without having to learn how to put on all these complex short instruments or trades. Now, I know that might not be like the design from an advisor or from a permanent holding standpoint, but I think you can actually use this tool to speculate in a way. I don't know if you've given that more thought since we last spoke, but I find that to be a compelling case for the everyday person.
It is a way to do that, and it's a way to express that view, and also a way to express that view with the humility to know that if you're wrong, you're still going to be okay. Exactly. If you're wrong and the market keeps going up, you're going to participate in that. But if the market goes down, you're going to be getting the same benefit, to that 15% inverse cap that you would if you had just expressed that view with options or just with the a short position. So great way to do it. I think it's a much safer way to do it. That's not the main use case that we see with the the billion plus that's come into these strategies since they launched months ago. But I think the applications are just starting too. There's a lot of new applications that we're seeing come to market every day.
Tell me about that. And obviously, you guys, a little corporate news as well. I don't know how much you want to comment about the Innovator and the Goldman partnership and the purchase, but I feel like that is obviously a recognition of the popularity of the strategy. And in terms of folks finding utility in different use cases, tell me some more about that, Tim, in terms of kind of what you're seeing and what's the most popular way or what the most kind of typical client looks like. And as you explain that to us, I just pulled up kind of the graphic here on what you're discussing earlier.
Yeah, absolutely. I mean, with the Goldman news first, Oliver, obviously this is something we're very excited about. It clearly shows that this is beyond just a little niche. The defined outcome landscape is growing. It's going to continue to grow at a very rapid rate. And you have the Wall Street behemoths like Goldman Sachs that have taken note, and really excited to add their capabilities to the innovation that we're bringing to the table here. In terms of the use cases, when you see that payoff, again, being able to make money when the market's going up as well as when it's going down, the use cases are endless. We have a lot of advisors, especially this week with a lot of the noise that you're seeing in some alternatives like gold and silver. Hey, this is a way that you can put a hedge into your portfolio and not have to worry about, is the asset class going to continue to do what you hope it does when the market is selling off? So a kind of an alternative sleeve is one way that we see that, a liquid alt, if you will. Okay. We also have another component that will use it as a fixed income replacement. Again, same thing with bonds that didn't do what you wanted them to do in 2022. About half the time we see in market corrections, they work with that negative correlation. Hey, this is the way to have that negative correlation with options, how we're constructing that payoff. So it's there at all times. And then obviously you have some of the more conservative investors, your retirees, your pre-retirees that they don't need a 20% move up in their portfolio. They're going to be okay with 9%, 10%, 11%, whatever it is, while still making sure that they're in control of risk and also being able to smooth out their returns. So, they might not be able to afford a year where the market goes down 5, 10% because they're not hitting the growth objectives. Well, hey, with a DDFF, again, the 15% dual direction strategy, it's a good way to help increase their chances of meeting those return objectives.
Understood. And that's a big theme here on this whole show from day one, which is answering the increasingly complicated problem of bonds in the portfolio with various solutions. Options obviously are the way we've talked about it mostly here, but there are competitors to that. Like that was kind of the argument of some of the Bitcoiners and gold bugs. Some of those have worked better than others. Some of the private market asset sellers would argue they're competitors for that kind of bond slice. What would you say to those, Tim? Options are they proven the best? Because actually I was talking to somebody the other day who's looking at the bond market and saying, hey, our credit approach is the original buffer. That was kind of an interesting pitch, I got to be honest.
Well, I think there's a lot of people there that are right, Oliver. And, I say this as someone who spent several years as a fixed income strategist. But when you look at a fixed income allocation, you look at the ag or any active manager that's using the ag, we see a couple issues with that. One, the inconsistency of the protection that they provide. You look at all 28 different market corrections of 10% or more going back to 1960. The catalyst for half of those market sell-offs is rising interest rates. Now, not to the degree that we saw in 2022, but still, that tells you your bonds aren't going to be working the way that you want them to. They aren't working the way they did in 2008. So that inconsistency into protection is one. But my bigger issue here is really with the tax inefficiency and then also just the upside potential that they bring to the table. Oliver, I can tell you with a high degree of confidence right now, if you buy the ag or some subset of the ag today, over the next decade, you're going to be getting a total return very close to 4.25% every single year. Now, yes, there's some years where you might realize it earlier if interest rates start coming down. There's other years where you might realize it later if interest rates are going up. But if I look at
that unknown, that degree of unknown, right?
Do I really want 40% of my portfolio in something that has a ceiling, if you will, that's that low? And I think strategies like this, the buffered ETFs, the dual direction ETFs, it's a way to take those low risk dollars, tie them back to the upside of the equity market, and increase that cap. So take your cap from 4.25 on a bond allocation to DDFF, you're taking that up to 9%, plus the inverse cap on the downside. So it's more consistent risk management, and it's higher upside.
Okay. Understood and good argument there. I want to make sure, Tim, that we kind of talk about a few of the other offerings, because I think that depending on what's hot in the market, you might find different buffers that work. Like I was kind of asking to myself the other day, and here on air, I was like, when are we going to get the silver buffer fund? Like, we can do this for pretty much anything that's got options, but one area that you guys have focused on is the small cap. Tell me about KJAN real quick, because I've got increasingly a lot of guests talking about getting into the small cap world. Does the buffer make as much sense here, or are we going to small caps for the risk?
Yeah, I think that's a great question, Oliver. We see a lot of catalysts, bullish catalysts for small caps this year. Fed cuts, being one of them. But you look at KJAN, okay, you have a 15% buffer on the downside. So small caps go down, 0 to 15, you're fully protected from that. Anything beyond that, you're still protected for the first 15. But then on the upside, I think you want to ask yourself, how much upside do we see in small caps? KJAN has a cap north of 17% over the next 12 months. So
Okay.
if you think small caps are going to run up 30, then yeah, maybe you want to go just long IWM. But if you do realize that there's real risks that are out there, I think we're seeing that right now, then you want to have the buffer in there. And for a lot of our clients, small caps is an asset class that is too volatile for them to hold or too risky for them to hold. The buffer allows them to gain access to that asset class because it's going to take about a third of the volatility off the table. It's going to add that layer of protection. But in our view, you're getting access right now to an asset class that is much more attractively priced. You're starting to see growth pick up, so we think that really helps. The rally that we've seen broaden out, and we think small caps is a big part of that.
Okay. Well, it certainly seems to be getting increasingly in vogue, the small caps. And we were literally in 2 conversations ago, guests saying, hey, this is where you want to hide out. So if you need to adjust your risk profile to make it work for your clients, KJAN, another one. Appreciate it, Tim. Appreciate the participation in the show and the banners and the ads. Thanks for rejoining.
Great to see you, Oliver.
You got it. Tim Urbanowicz, Chief Investment Strategist at Innovator ETFs. That was the Cboe Exchange Traded Profile. And today, I think we need to go straight into our next guest who's joining us from Prosper Trading Academy. Mr. Scott Bauer is on the line, and the market here has got 10 minutes left to the nose. Scott, this has obviously been a very kind of crypto heavy day, but it also is a bit of a stock situation as well. Tell me where you start in today's analysis because there's a lot to choose from.
Yeah, so crypto heavy day, and one thing we talked about yesterday, Oliver, ahead of Alphabet's earnings was that CapEx, right? That if that CapEx number was, off the charts, which it came in, that the street might look at that as a negative reaction, and that's certainly what happened here. I think in the long run, that becomes a positive thing. But for right now, the street is so concerned about overspending here. That's what they looked at there. So you have that. You have the crypto just absolute. I don't know if I even call it a meltdown or just
something like
an
that.
annihilation. All of the above. It's actually unbelievable. Today is one of the highest volume days that I have seen for micro Bitcoin futures over at CME that have traded. So I think that there is a lot of capitulation going on there. And I'm starting to see that a little bit through some of the equity spaces as well. We are starting to get to really oversold levels on a lot of individual stocks. And, if I don't want to say if you have the added risk to put on, because I don't look at it as risk, to me, it could be a good opportunity to start, dipping your toes into your favorite stock or maybe even your favorite sector that has just gotten trounced over the last week or so.
Yeah, we're kind of going for the baby with the bathwater here into the close. Semiconductors, which had been positive and holding on, down 60 bips. To me, that's a chart that still looks very, very fine and ripe for dip buying. And by the way, Scott, on the bullish Alphabet call, it's only down 80 bips. You're looking at a potentially green candle here today for Alphabet.
It actually was down, 23 bucks, I think, at its low. It's almost back to unchanged on the day, which I think people are now looking at that in that initial reaction of, oh my God, how could they be spending so much money? What if? Now that, I think people are digesting that and saying this could actually be a good thing. So given that intraday move we have seen in Alphabet, I like it even more now. I know I was very bullish yesterday going into the print. I like it even more now because of this recovery that we've seen.
It's pretty rough out there for the coin, Scott. Let me just go back to it real quick here. I mean, it's getting worse as the session goes on. Bitcoin now down 15%. And boy, that red line down there with the dash on it, my arm's going to get sore from back patting myself at this point, Scotty. But you were here with me on the analysis for the technicals where we looked at those lines in the sand and said, hey, if this thing cracks the range that it's been in, it could still move in a hurry. This is not lost. This is not lost its character. This is still the place for potential massive downside at any given moment.
Man, we're talking 50% drawdown since those highs just a couple months ago. And yesterday we talked about 60,000 maybe being the next step, but it almost got there this morning. I think we traded down to 62 and a half or so.
We're 62.7 right now.
Yeah, it is really ugly. I have a question for you. In your, I don't want to say wildest dreams, but in your analysis of MSTR over the last 6 months, 9 months, where you were out front and an incredible bear, did you think that this stock could hit $100 per share this
Absolutely.
early? Yeah.
Yeah, absolutely. I think it's, frankly, Scott, I think it's a zero. And here's why I feel that I can say that is because I don't think Bitcoin is. I think based on my analysis, I think Bitcoin will trade below $5,000. I think it has potential to go down to below $1,000 again. I wouldn't be surprised by that. Now that the way I've thought about Bitcoin is kind of relating it to stocks, and a lot of those kind of relationships have gotten out of whack, so it's hard to know where it could go. But for me, Master is very clear, which is that if my Bitcoin view is that this thing's, a sub 10,000, let's even say generously it's a sub $10,000 asset, then strategy's screwed. It's game over.
Yeah.
They break even at 75. Buying at higher and higher highs. So strategy in my mind is, could disappear.
And not only strategy, but look at Tom Lee's fund and just that whole space right now. And I think what you're seeing is a lot of the I always mispronounce this, hodlers, whatever you want to call them.
Right, yeah, he's pleading for him today. He's pleading. Hodl.
They have started to capitulate. And that is because this whole narrative of what crypto and what Bitcoin is for has now pretty much been thrown out the window, to be honest. And I know there's people watching this, and there are the Bitcoin bulls and blockchain believers out there that are going to say, oh, it's just going through a really bad cycle right now. And that may be. But you have people that on these liquidations we've seen over the last week or so, these are liquidations of coins that have been held for a really, really long time. And people just saying, all right, enough is enough, because the narrative has changed. There's no question about it.
Yeah. It's just that, when he's tweeting out things like, hold and iterating that, it's this, the swarm of cyber hornets and all that. It's nonsense. And it really tells us that, this really is about a kind of cultish following. And if your guy, your leader, it leads you down this path and you decide that you don't want to go down it anymore, which is what the market is telling us with these people not listening to him and not holding. That's why I'm calling it mutiny. It's basically mutiny, and that's the risk of being a cult leader, I guess.
Bitcoin and the like has now become a really, really good trading instrument, not an investing instrument, at least for right now. So I think that's what you're seeing. That's why volumes are huge right now. And there's no end in sight. There really isn't. I'm not even sure that, any sort of shift in the Fed in terms of pushing up a potential rate cut helps the crypto stance right now. In fact, just today we saw quite a notch up in the March probabilities for a Fed cut, which we're basically down to less than 10% just a week ago. It's not 50% yet. That's ramping up, though, and that still has not helped Bitcoin.
Great point. That's a really good point, Scott. In fact, I think it might be going in the opposite direction at this juncture, because if you throw more juice onto the economy, this is the way it works. The economy's solid, which we saw in the recent data, it is, and you're going to throw even more juice into that by cutting rates, then that means we're going to discover the real value of things. We're going to produce more things. I think in many ways AI was very much a Bitcoin killer, because it gave us something that had both exciting kind of cult following potential to it, but actually was producing something and actually doing something good. So then we don't need something that, that's just pure speculation. The quantum stuff that we're building, all these things are the products of a healthy economy, which present alternative investments that actually have value, which is not good for something that doesn't have a productive value.
You're right, and I'm looking over here because I'm trying to see what some of the markets are in MSTR with earnings coming out, and the market's pricing in here about a $14-15 move, so about
That's right.
15% move. The
I
90
almost forgot about earnings.
yeah
Strategy earnings
the
tonight.
90 puts may seem cheap. They're only trading $1.50. I know it's totally binary. You got 1 day on it, but tomorrow's 90 puts are $1.50. Who knows?
Yeah, that's a good point for earnings. It could be, maybe you buy, maybe there's a way to just bet on the vol, but I mean, this is going to be very fun because if they find anything in here that's not good, then, who knows what's possible, but at the same time, it is oversold.
It is oversold, but how is he going to talk his way out of this?
Great point. I don't know.
Other than just pounding the table and say, Bitcoin's the ultimate buy right here. I mean, what else is there for him to say?
Well, he told me as I had up when I saw him that I was going to get my face ripped off. There's our picture, me and my best buddy in Vegas. But I'm not going to be too big of a jerk here. Scott, to your point, the last thing to come back to the data here and the numbers for earnings on Master. To your point, cheap to even still kind of, not expensive to bet on potential deeper slide.
Not expensive at all. The puts for tomorrow, obviously big binary event, right? One day it either happens or it doesn't happen. But if you, let's say you were to go out a little over a month to March, the 90 puts there are trading as high as $10. So you got to hit $8, to get a break even there. But I don't know. Certainly is not out of the realm of possibility. And I don't know if you watched the tape here, but Alphabet actually got to the flat line on the day. I think it's down, down 10 cents or something on the day here.
There you go. Nice dip buying there for Alphabet. That tells me that your long-term view still very much intact.
In place, very much intact. Very much intact.
All right, boy, I'm going to start. We got to get something going on Friday for these shows because I need to have some thoughts on Master tomorrow. It could be a fun afternoon. Thanks, Scott.
It definitely could be. And for those that don't know, the January non-farm payrolls, which we were supposed to get tomorrow, are now coming out next Wednesday.
Okay, so we lose a catalyst. But it seems like the market is not in need of one right now. It seems like we've got plenty of organic catalysts. Great stuff. Scott Bauer, thanks. Good thoughts on Alphabet yesterday. I think ring true in the dip buying today. Good thoughts on Master going into earnings as well. Mr. Scott Bauer, that's it. We got to jump. Thanks for tuning in to Chicago Future of Finance. Very fun show. I will see you Tuesday. Good luck trading the coins tomorrow, Master tonight, and over the weekend. Adios.